Good morning, and thank you for joining us for another session. Just covering a lot of the basics these past couple of months, but one of the conversations I had with an owner recently is just trying to get a better idea of where they're going with this investment and how they got into it from the beginning. Obviously in this market, there's a lot of conversations about sale versus rent, and at the same time, I recognize not a lot of owners that we do in fact work with intended to be investors right out of the gate. And so sometimes it's just a matter of knowing what your mortgage is and what your insurance and your taxes and the PITA, the principal interest, taxes and insurance costs are, and generally not necessarily knowing how profitable the property is. And sometimes that may not even matter. But in these conversations, I wanted to go through a lot of the data-driven strategies that we've worked with in terms of giving owners guidance on how best to navigate the role of being a landlord and whether their property does make for a good investment. And sometimes it may not matter. Sometimes just making some revenue off of the rent to cover your expenses because you intend to hold this or move back into it is in the cards. But as we go through this, we were talking about a lot of the lingo, and some of it might be foreign, like some of the terms my teenage daughter's using these days. But we want to try to maximize the ROI, the return on that investment, and knowing what the market trends and the performance and being knowledgeable about what's going on will help give guidance on when it makes sense to position yourself for best success. And so I want to start by, before we get into some of the metrics and stuff that we're tracking and utilizing to be able to give owners good guidance, I wanted to talk about a lot of the terminology that may be foreign to many owners that are tripping into this as a unintentional or a landlord that was presumably living there and already knows what some of these hard expenses are before transitioning to a rental property. But many people will look at what the cash on cash return is. And so the annual return that investor earns on that initial cash investment. So consider your down payment and what you put into this, calculated by dividing that annual cash flow. This is a metric that focuses exclusively on the actual cash invested, excluding the borrowed funds. And so how much money did you put into that property to get in the door? All right, we'll talk about the mortgage a little later. The internal rate of return, it's a metrics that estimates the profitability of that potential investment. Not many people will look at this when they're looking at it as their independent or their future home, but many will when they are looking to put an investment out there. Okay, and this is also something that you can annualize the rate of return on that investment. The net gain on that investment, the total profit the investor realizes from the investment over that hold period. So if you're purchasing a property and your goal is to have it for 10 years, this will help with those projections on what that's going to look like, calculating that hold period, the annual cash flow and the appreciation in the property, because we do presume all properties will increase in property value. And then, of course, what you'll be able to get at the tail end as opposed to what it was that you purchased it at. So presumably all want to sell high and buy low. And over the years, DC continues to see a 6-point rate of return on those appreciations. We want to talk about that annual cash flow, right? Because in theory, many people will just look at what's month to month, seeing that, hey, I'm renting it for 1,000, my mortgage is 800. I want to, make more than 200, but sometimes you don't realize the additional expenses that may be incurred, and sometimes a loss is perfectly fine. There's other income and that can count against, but it's something that you should be aware of as far as the annual cash flow, not necessarily the month-over-month returns. Now, I mentioned earlier the hold period, the length of time that you plan to retain ownership. Many owners might be looking to get back into a property over a 3 or 4 year term. And a lot of owners say they're going to return to DC, and not everyone does. So just knowing what that expected return is, as opposed to seeing how the market works and where it will align with the next vacancy and making a decision at that point. We give guidance on those to owners with some regularity. We're looking at the potential rental income. You need to know what that income is. That way, it's better to budget. You know what your income is, you know what your expenses are, and that's going to be the delta. And so knowing what that potential rental income is really important and basing it on 100% occupancy throughout the course of the year. There is potential rental income, which is what we're expecting. But then we'll also talk about the actuals, right? Because there is going to be vacancy and there is going to be credit loss and there is going to have to be some allowance to expect that turnover, the late payments, the unpaid rents, et cetera, et cetera. So that's vacancy and credit loss. The effective rental income, it's the actual income expected to be collected after accounting for that vacancy and that credit loss. It's been preached many a time that the longer the tenants stay, the more you'll make. It is that vacancy, the turnover, the lost income from that revenue, and of course the leasing and turnover expenses that certainly can count against all those projections. So the longer the tenant stays, the more you'll make. We want to talk about operating expenses, the regular and ongoing costs incurred to operate that, the maintenance specifically. But you'll also include the taxes and the insurance and the management fees, the maintenance, the utilities, et cetera. And sometimes we don't have that big picture, but those are things you need to track for sure as you're going through this and making sure that you're incorporating all of those into the true operating expenses associated with that investment and making sure that your accountant is aware. Net operating income does come up with some regularity. The income generated by the property after deducting all those operating expenses without those debt services, without the mortgage, all right, and capital expenditures. And then last couple is going to be the net non-operating expenses, which are going to be those capital improvements. The total cash flow is going to be the final balance remaining after those properties expenses are deducted. So I wanted to point these out because these are phrases and lingo and terminology that most may not be mindful of, but they do have an impact as we start going through to determine best use and the best approach to taking care of the properties. Because in the end of the day, just having that gut instinct isn't really going to get us where we want owners to be. We really want to be able to crunch real numbers, and a lot of that's going to be the data driven because we want to take the guessing game out of it, not for rentals. Everybody needs to anticipate where they're going to be and what they're going to be getting out of that investment, whether or not it is going to be profit or loss. And sometimes, quite frankly, we do have to have conversations with owners with loss because rental rates and what renters are going to be paying for properties do fluctuate. It's a conversation we're having right now because there's a fair amount of supply and not a ton of demand. And so knowing those forecasts really do help. But we'll also get into the market shifts because that pricing, that demand, and the tenant preferences, those things do change over time. There was a good trend where people were looking at smaller units pre-pandemic, but being cooped up in a 400 square foot efficiency when all of the bars and restaurants that you move to be close to are closed does have impacts, right? And we want to use this data to make that competitive edge because there will be easy examples that I'll give later, but asking for that extra $75 a month really offsets an extra month's worth of vacancy if it can be avoided. So we don't want to ignore the market data. Overpricing does have an impact. If you start out too high, inevitably you're going to see a longer vacancy period and you're going to not necessarily get the traction right out of the gate. And most often we'd want to wait 10 days to 2 weeks before we start making an adjustment on the asking price because we want to make sure that the ads that are being posted are being syndicated, being seen, but then we got to track it. And one of the great little examples that we use just is within our showing software, where we're able to see the market trends and they ebb and flow. It is regular ups, peaks, and valleys. And even in this, you'll be able to see that over the last month and a half, going back to July, we had a really high peak of not only leads that we received across the properties that we're managing, and quite frankly, we'll have more units on the market than most individual investors. But we also see how many showings are being created and how many showings were conducted. And you'll see that trend. There's inevitably going to be people that look, narrow their search, be able and only pound the pavement for a select few. I heard the statistics a very long time ago, and I'm sure it still holds true to form. But people will look online all day and all night. But when they get serious, they're probably going to narrow it to their top five, probably only see three, and then potentially pick one. And this does kind of align with the number of applications that we received, as well as the number of leases that we've signed. And we do monitor that very closely, so that we know whether or not there's a slowdown in the market, which, especially this time of the year, I've seen only a couple occurrences where the market slows as early as Labor Day. But as we get into the seasonality and the holidays, it becomes almost inevitable. Um, the adverse, underpricing. We know we're leaving money on the table. We don't want to leave much money on the table if we can avoid it for you. In theory, if you can make a couple of extra bucks, or if you're grossly underestimating the price, yes, you're going to rent it quickly. Yes, you may get a great tenant, but that does begin to add up, especially as those tenants that are in the unit that know that it's well underpriced won't want to leave. They probably may put some concerns up against the rent increases when you try to impose it. And quite frankly, some owners may not impose any increases annually because they want to keep their good tenants. And all prices across the boards continue to increase year over year. And so having some form of an increase in place annually makes sense. Whether or not it's $10 to $20 or more, it's worth knowing what the market is allowing and keeping pace with it. Um, I touched on this earlier, but leasing at the wrong time has an impact. If I have conversations with owners right now that are looking to work with us, October and November and December is a different conversation than we would likely have in March, April, and May. Um, Retention is a big conversation right now, but the time of the year that it goes on inevitably is going to have an impact on that vacancy period and how long it may take to find that tenant. And the longer it takes might also start having an impact on that pricing, right? And knowing what you're offering, the amenity trends. Right now, there's a big conversation about pets or no pets. Just as a add-on, whether or not units have storage, parking. In fact, as far as parking is concerned, we have a lesser need for parking across the boards than we had in previous years. And so we want to know what those trends are, and that way we can attract those high quality tenants and know what they're looking for, right? Now, how do we track those trends? I just showed you one from one of our software, the showing software that we use. But we also will be looking at a handful of other softwares that we use. One of my favorite is Renometer. It will ultimately be able to give us some numbers just in terms of projections and what the market trends are in those specific neighborhoods. But we always want to double check it against a few other things. Sometimes the affordable housing website, to see if there is an opportunity to get more market share or market rents through the programs. Knowing what market rate units have gone through the Bright MLS. But most owners will be able to see what people are asking on Zillow. You might be able to see it on a couple different media, but what they're asking and what they get and how long it took to get it are two different things, right? And so knowing that additional information is very helpful because we can see the potential price adjustments. So and across the boards, I was just doing comps for an owner where we have seen that other units that are relatively nearby have made several price adjustments to be able to secure a tenant. And it took, 60, 90 days before they were able to secure someone. Going straight to what the actual price is that will be able to get you that resident sooner than later does pay dividends, right? And that can have that impact on that seasonal demand. And it is in DC and Maryland and Virginia all have different trends. And so knowing what's going on nearby is critical. Those vacancy rates and those days on the market, they do have an impact. And the tenant demographics, the lifestyle shifts, migrations from the red line to the green line had occurred a handful of years ago. And then since then, I think that there's been a shift back to the red line in many neighborhoods. And that's not necessarily always going to be the case, but we do track it because we do have a sizable portfolio that we're able to see the different markets in the different neighborhoods and almost regularly have units coming online in different areas of the city, plus the visibility on what others are offering. So the tools that we use, I mentioned the rent range, the renometer, mentioned the local MLS. We look at those vacancy and absorption trackers, just knowing what the market tends to look like, because if there's more than a 5% vacancy rate in any area, that's going to become more of a tenant market. Under that becomes more of a landlord market, specifically southwest down by the ballparks, southeast rather. There's a lot of inventory. There's been a lot of inventory in Foggy Bottom. And so knowing how those properties are being absorbed and the timeliness of it, especially when there's new development being added, new properties being added to the inventory in the area, it can have an impact as well. We want to review these reports. We do share these trends, and we're dissecting these every time we're meeting with a new owner to see how they fare and if they're in line with what we're looking for, and whether or not there's opportunities for adjustments or improvement. And we're going to give you that owner portal where we can share all of this so that you have availability and begin to get that knowledge of your own. And so we can take that data and we can turn it into action. So you gotta figure out the best way to strategically price the property. That's going to help you maximize that income and reduce that vacancy. It's going to help us with the renewals. A lot of times right now, in fact, there's a handful of owners that are deferring those renewals, trying to stick with the status quo and want to revisit the conversation come spring when it might be a slightly different market. Others want to be a more conservative approach and try to work on getting that tenant locked in. So not only will they make it through this winter, but potentially another. And so those conversations we're able to work with and align with those when demand will essentially peak, which typically is going to be late spring, early summer. And if there are opportunities for us to do some upgrades in the property, not that's always something that we're open to doing. Some of them may make sense during a turnover. Others might be worth exploring during the tenancy, but we'll want to talk to you about that as we do our inspections and share our suggestions. But in the end, you don't want to just leave the property stagnant. Just because a tenant's in there doesn't necessarily mean that there isn't potential for improvement, right? Consider that when those appliances are coming due or when the lease is up for renewal, it might be an opportunity to do something to make sure that the tenants do in fact remain happy, because happy tenants stay longer. So performance metrics that boosts that profitability. We have measures in place to help pursue the rent collection and rates. In fact, we have a 99% rent payment right now. 99% of our tenants are paying their rents on time to us because of the systems that we have in place. There inevitably will be a handful that don't pay timely. We pursue it, and we have our measures in place to take action. And of course, there is some potential adjustments to this process that went into effect as the council voted off on the Mayor's Rental Act this past week. But it will be a bit before the mayor signs off and before it will in fact be implemented. But if your tenant is not paying rent, this will give you an opportunity to pursue it more timely and expect that they're going to be making those payments to the court while they're not paying you. So rent collection is essential. If a tenant pays on time, and quite frankly, life is always easier when people do what they're supposed to. But if rent is paid on time, that's one less concern that you're going to have. And of course, if the rent is coming in and you know what that income is, then the next conversation is dealing with the maintenance and the response times and making sure that those things are done timely, but also that they're done efficiently and cost effectively. And sometimes it makes sense for us to do the upgrade as opposed to just doing another Band-Aid on it, because those are going to have an impact on the renewal and potentially those turnover ratios. And of course, if you do have a vacancy, then you're going to have to look at how long it's going to be vacant and what is happening with you versus the rest of the market. And then, of course, all of this is going to have that impact on that return on your investment. in the end of the day, we want to make sure that the cash continues to flow, and that you have that income and it's steady. Because we've gone through this and we've tracked how sometimes we will have small adjustments that go a long way. Making a quick little 75 adjustment on a property a couple weeks ago helped us get it rented sooner. Another owner that had one relatively comparable was adamant about leaving where it was, and it took them almost a month and change longer to get it leased up. Especially when there's going to be high competition in the area, and there's multiple units that are similar, you have to be mindful of what those best alternative options are. And in the end of the day, if everything else is equal, the tenants are going to likely take the cheapest, right? But we want to also track those renewal cycles. By getting people onto a better cycle, we generally are able to increase those renewal rates by 20%. So just the time of the year and the dates in which those renewal conversations are coming up will have a significant impact. Generally not awesome to be able to promote a rent increase right around the holidays. We try to avoid that when we possibly can. All right. And by doing all of this, we're keeping the owners ahead. We're continuously monitoring the market conditions. We're giving you proactive strategy updates. We're giving you that transparent reporting, and that showing software that I had showed you previously. We give owners weekly updates so they know who's seeing the ads, what kind of interest they're getting, what the feedback is from those potential applicants. And knowing that helps us make determinations on if we want to leave the rent the same, ask for a small adjustment, or we may have to make a large one to really improve the visibility. So as we go through this hands-on partnership, we're really working hard to protect your investment, which is going to be making sure that you have that steady income generated, so that you can hit all of these indicators that I talked about at the front end. Whether or not it actually does have an impact on your overall budget, that's for you to know. But we want to make sure that the investment, the property that we're working with you on, is going to be as profitable as possible, given the conditions that we're working around. All right. And so, as with all sessions, I'm happy to provide a little Q&A session. So if there's anything that I can help answer, I'm more than happy to give everybody a few minutes to throw their questions into a chat, and I can expand upon it. But before doing so, I wanted to do two quick things. First, if you aren't sure how your property is stacking up with market, and where you position against all that is nearby, I am happy to do a free rental analysis of you. I'll be making sure that I send my calendar link through our follow-up. That way you can just click on it, book a 15-20 minute call. We'll be able to chat about what you are, where you're at, what you're getting, maybe any of the issues that you potentially have that you're trying to streamline, and let you know whether or not your property is in fact, covered, well covered. Maybe even dig into the lease or the licensing or anything else that you've been troubled with over the last, since you've been working with the investment, or if you're just beginning to consider transitioning to an investment. I'm happy to do that for anybody on this call. And the second part is that, and anybody that does make the transition, we're going to be giving out 2 months management on your property if you sign up by the end of October for our ongoing services going into the new year. I'm more than happy to talk about it, and perhaps maybe those two can be parlayed into one conversation. We'll see where you're at, and we'll talk about what those next steps would look like, because in the end of the day, your time is not deductible, but our fees are. And I know many owners may do this themselves, but in the end of the day, it's through our expertise and our guidance that will really set you apart and take a lot of that heavy lift off of your shoulders. You'll never be 100% removed from the equation, but we can take a significant portion off of that responsibility from you. So as I wrap up, I want to say thank you for joining. I'm looking forward to talking to a few people. And before I go, are there any questions that I can help answer?
Yes, there are two questions. Okay, the first one, what systems do you have in place for timely rent payment and late rent collection?
All right. Well, let's start by screening the tenant properly. It all goes back to our marketing efforts to try to secure the best quality applicant, and then making sure that they are in fact in a position to help pay the rents on time, that they don't have significant debt, that they make good money, the credit's good, they have a good track record of meeting those obligations. Now, granted, we all know people lose jobs, couples break up, but that's a snapshot in time, and that's step one. Step two is going to be making sure that we remind them that rent is due. Step three is going to be making it easy for them to be able to make those payments. And so all of our residents have a tenant portal where they're able to go in and pay by e-check, by credit card, a couple of other options. But ultimately, we want to make sure that the payment capacity is easy. Now, in DC, Montgomery County has a different late grace period that they call it. But once it is in fact past due, we want to post that late fee. We want to start with the reminders. We're going to call, we're going to text, we're going to email, and we're going to try to figure out what has happened. Now, when I told you earlier that we have a very low delinquency rate and a handful of non-payers each month, truth be told, more often than not, they're the same names on the list, right? But we want to follow up and we want to figure on what's going on. And if they are new to this list and it hasn't happened before, we got to know what's going on. And even with those that are habitually late, we want to make sure that we understand where they're at and why we're not getting that rent on a timely, regular basis. Because in the end of the day, they're just paying more on the late fees, and it's more work for our team. But we want to call, we want to text, we want to email, and then of course we want to act fast and get this over to the attorney sooner than later. The way that the court system's set up and the way that we have to go through this and until they start to unravel some of the pandemic era adjustments, we want to make sure that we're taking action sooner than later and getting the 30-day cure quit notices out. That way, that gives us an opportunity to file for non-payment and not give them too much leeway. And our residents do know that we are going to take action fast. So I hope that answers your question, but all of this goes to promoting that timely payment. And I can say softly that majority of the residents that do in fact pay late typically do get it in by the 15th, so that the owners really don't see much disruption in that delay. But of course, if this is going to carry over, catching up on 1 month is a challenge. 2 months is probably 4 times as hard. 3 months is almost getting to the point where it may not, it's going to be a significant challenge to get back on track.
All right, the next question. What is the average monthly cost for contracting with a company to manage a condo?
Um, we have our fees based off of the monthly rent, and I've seen companies, there are a few that are flat fees, but you're probably going to get what you are paying for the bare minimum. But we do a lot for 8% per month. I recognize that a lot of different companies around the area probably are charging someplace between 6 and 10 on average. But we've been charging 8%, and you get a lot for that, especially considering what it costs for one trip to the grocery store or dinner out, what have you. You get a lot for those fees on a monthly basis from us. We're going to be doing the majority of the heavy lift and taking a lot off of your shoulders.
I think we had a question to follow up the first question we had. When do you send the initial notice?
Additional notice, what, to tenants of the rent
Or
being
timely
due?
rent?
Yeah, we're going to be sending that, around now, reminding them that October payment is due. Um, is that answering the question?
I believe so. There wasn't too much to that. Okay, so we have a couple other questions.
Oh, once late, DC gives a 5-day grace period. Other jurisdictions have different timelines, but we wouldn't be sending a late notice until after the 6th. And so we would wait, and we'll be posting the late fees and then immediately following up shortly thereafter once it is in fact outside the grace period.
All right, great. We have another question. Can you help to register my condo with DC? I have the rental permit already, but it seems that I need to register it also. Any advice?
Yeah, all right. The rent, I think we'd covered this in a previous session, but the rent registry that they went live with in June, is that what you're referring to? It is something that we have brought in and are working to do internally. We can do it with the owners that we are working with, and we have been working with them since June to make sure that everybody is in compliance. But we do not have the capacity to do with owners that are not under our management. So it will be a great opportunity for us to chat and see if that might be a possibility. If not, it is navigable. I have owners that have given me feedback on the process, which, by the way, they continue to edit and adjust since the beginning of June. I've gotten some feedback on that. But at the same time, I've heard that they have a limited staff and well over 6,000 applications in process. Um, if you would like to pay somebody to do it, one of my previous um, co-hosts with BBL processors does that, but I don't recall exactly what their fee is for doing it. But I'd love to talk to you about the property and see if we can help you internalize it.
So the next question from the same woman. Also, I was late joining this call. How can I sign up for the free analysis of my rental market position?
Thanks for asking. I'll make sure that I share out my meeting link in the follow-up email. I'm having trouble with the chat feature, and it's kind of hard to do while I'm talking, but we'll make sure that we share that out and we'll get something on the calendar.
Okay, great.
In fact, Elise, you can make note. I can potentially reach out right after this as well.
Okay. The next question. If you are managing several condos owned by one person, do you offer a reduced management charge slash fee?
I'd love to talk to you about that. Yes. It depends, might be my favorite answer, but yes, I think that we've been working with owners depending on the number of properties and the rates. It's certainly a conversation that we can have.
All right, that's all the questions I see for now. Thank you for those lovely
Awesome.
questions.
Well, thank you all for joining me. And if there's anything else I can do to help, let me know. I'd love to chat with you all and be able to give you a little guidance on where you stand, whether or not it's for action or just curiosity. That way you know where you are. Thank you so much.